In this video, I'll go through everything you need to know when it comes to dividend investing, including the common trap and the different strategies that you can employ. Along the way, I'll be sharing my own experience when it comes to dividend investing, and I've made this video to be as beginner friendly as possible. I've left timestamps on all the important dividend investing concepts in the description box below, so you can always come back and use this video as a mini wiki. Before I get started, I just wanted to say a massive thank you. It means the world to me that you're choosing to spend time with me. And even though I am still a massive work in progress as a content creator, I promise to keep getting better so that the time we spend together is always fruitful. As usual, this video is just my opinion and it should never be used as financial advice. But if you do learn something new, consider gently smashing that like button right there. So without further ado, let's go! Now, some of you might be wondering, why the heck do you like dividend stocks so much? You see, one of the things that I love the most being a kid is receiving red pockets during Chinese New Year. Do you know what red pockets are? Money. Cold, hard cash. No. Don't get me a gift. I don't want to deal with the probability of being disappointed.
And I can't even ask for a receipt to get the refund so that I can get the cash to actually buy the things I actually want.
So dividend stocks reminds me of getting red pockets. The awful jokes aside, the stream of passive income is really what attracted me towards dividend stocks in the first place. Now, I've broken this video into 3 main segments in order of importance. First, I'll go over the fundamentals around dividend investing. Then, I'll talk about the most common mistake that you could make and how to actively avoid it. And then lastly, I'll finish off this video with the different types of dividend investing strategies that you can employ. When it comes to a stock's dividend yield, the way you calculate it is the annual dividends divided by the current share price. What you need to remember is that the dividend yield is just a current snapshot of the reality. It doesn't mean that you are going to get paid or yield that percentage in the future. Let's use WAM Research, which is a listed investment company that I own, as an example. Over the last 12 months, WAM Research have paid 9.8 cents per share. And if you divide that by the share price on the 23rd of October, you should get 6.9% dividend yield. There's no specific reason for choosing the share price on the 23rd of October, it's just when the calculation was done. And I will be talking about the gross dividend yield in just a second. The dividends are paid to your nominated bank account.
And since that's income, you have to pay taxes on that.
On the topic of taxes, let's talk about franking credits. When a stock pays dividends to their shareholders in Australia, they have an option to pass the taxes they paid on that income to their shareholders as a form of tax credits. The whole point of this is to prevent our government from double taxing the same income on a company level and then the same income on a personal tax level.
We all know how greedy they can be.
But in order to get the franking credits, you do have to hold the stock for 45 days. For example, this is a screenshot of the final dividends that I've received from WAM Research. And just focus on the franked amount and also the franking credits for just a second. The franked amount of $817 are dividends that I received from WAM Research after they've paid taxes on them. And the amount of taxes they paid and have chosen to pass that tax credit to me is approximately $350. So altogether, I would have received $817 plus $350, so a total dividend income of $1,167. And say I earn $30,000 a year with a tax bracket at 19%. The taxes I will have to pay on that dividend income will be 19% times by 1,100, which will give me approximately $221. But since WAM Research have already paid taxes on that and have chosen to pass that amount to me in the form of franking credits, you can see that the franking credits more than covers the taxes I will have to pay on that dividend income. That's the essence of how franking credits work. And if you have more questions, just let me know in the comment section below and I'll try and get through all of them. Of course, companies don't have to pass on their franking credits, or they can choose to just pass on a portion of that. But the concept is largely the same. Before we move on, the gross dividend yield just includes the franking credits as well. That's why the gross dividend yield will always be higher than the dividend yield. And if we look back at the WAM Research example, you can see that their gross dividend yield is close to 10% compared to a 7% normal dividend yield. Okay, what about all the dividend dates? Well, there are 4 main dates. 1, you have the declaration date, which is essentially a payslip. You will know when you will get paid and how much you will get paid. And then you have the ex-dividend date, which is the date that you need to purchase your stock to be eligible for the dividend. And then the record date is just for the company to check who's entitled to dividends. And then the payment date is essentially when you'll get paid. Just to show you a real example, this is a screenshot of WAM Research declaration on the 25th of August 2020. They have let us know that the record date is on the 13th of October and you'll be paid your dividend on the 23rd of October 2020. That's a Friday, just in time for a night out. And the amount you will get paid is 4.9 cents per share. There are actually more information in the announcement on the franking percentage, but really all you need to know are the dates. The next thing we gotta talk about is the payout ratio. Now the payout ratio is the amount of earnings that's paid out as a dividend. And it's really easy to calculate. It's just the dividends divided by net income or earnings. If the payout ratio is ever past 100%, all the alarm bells should go off and you need to ask the question, why are they paying all of their earnings and some more as dividends to their shareholders? The general rule of thumb when it comes to payout ratio is that with real estate investment trusts, it's okay to have a payout ratio greater than 65% because that's the purpose of a REIT. But for a dividend stock, if the payout ratio is above 65%, I get pretty anxious and I wonder if they're reinvesting into their company enough to pay that dividend in the future. At the end of the day, dividends are paid out of net profits. If they're not reinvesting into the company, your dividend paycheck is not going to last very long. On top of that, if you want to see whether your dividends are safe, you want to look at the track record of the company paying dividends, especially during a downturn. For example, this is JP Morgan's dividend track record. And during the dot-com bust and the GFC, they have slashed their dividends. That's an indication that during a tough time, it's likely your dividends are going to be at risk. To be fair though, they have grown their dividends by 20% over the last 10 years. On the other hand, if you look at T. Rowe Price, they have consistently grown their dividends for 34 years through the dot-com bust and the GFC. That's a sign that when times are tough, your dividend checks are not as at risk compared to JP Morgan. The last thing that's really important to know is dividend reinvestment plan and dividend substitution share plan. When you opt into a dividend reinvestment plan, you're essentially saying to the company paying the dividend, hey, don't give me the cash, use that cash to buy more of your own stock because I want the stock. But because you get to keep the cash, can I have a small discount when you buy that stock before you give it to me? What you see on the screen is my WAM Research dividend reinvestment statement. And you can see that the dividends that I've received are converted into stock at a 2.5% discount. Now, depending on the company, they may or may not give you a discount when you opt into dividend reinvestment plan. But the most important thing is you don't have to pay any transaction fee when you receive that stock. Since the company have first allocated you cash and then use that cash to convert into stocks, that's treated as income and you're going to have to pay taxes on that. And that really is the difference between dividend reinvestment plan and dividend substitution share plan. With the dividend substitution share plan, instead of allocating you cash and then use that cash to buy stock, they are essentially just allocating you the stocks. The upside to that substitution share plan is that you only have to pay taxes when you sell those shares, but your capital gains tax bill could be very high sometime in the future. So substitution share plan is not always available, but when it is available, it's great for people in very high tax brackets. If you'd like me to talk more in detail about dividend substitution share plan, let me know in the comment section below. Everything I mentioned up to this point are all the key things you need to know when it comes to dividend investing. Now that we've got the fundamentals out of the way, let's talk about the most common mistake that you can make when it comes to dividend investing. The most common mistake when it comes to dividend investing is making a decision purely based on dividend yield. If a stock has a big, juicy 10 to 15% yield, it must be good, right?
Heck no.
You see, since dividend yield is a function between the annual amount of dividends being paid divided by the current share price, when the share price tanks, the dividend yield actually looks really high. The question is, why did the share price tank? Is it because of the business model? Is it because of management teams selling the shares? Or is it because of a pandemic that they don't have control over? Here's my mental checklist to avoid dividend yield traps. Number 1, is the dividend yield excessively high? If the yield is greater than 5%, we have to ask why. Why is it so high? And if it's greater than 10%, I tend to get very worried and I dig really deep into the business. Number 2 is the payout ratio. Is the company paying too much of its earnings out as dividends? Now remember, for a REIT, it's okay for the payout ratio to be greater than 65%. For a dividend stock, in my opinion, it's not really okay for a dividend stock to be greater than 65% unless they are really mature. And for anything that's above 100%, I tend to avoid, or if I'm really interested, I will dig into it more. Number 3 is the company growing its earnings year on year. At the end of the day, dividends are paid out of net profits and earnings. If they're not growing their earnings, that dividend check is not going to last very long. And if you want to go the extra mile, you want to look at whether the earnings per share is growing as well. Number 4, what is the company's debt to equity ratio? This is a personal preference and I prefer companies on the safer side with a debt to equity ratio of less than 1.3, which really just means that for every $1 worth of equity, they have less than $1.3 worth of debt. Of course, you can further build out that checklist, but this is something that I just keep on my mind to see whether I am falling into a dividend yield trap. To quickly recap, I've covered the fundamentals around dividend investing, including taxes, and how to avoid the dividend yield trap. But the juiciest part to most people are the dividend investing strategies. In my humble opinion, there are 3 main strategies when it comes to dividend investing. The first one is called dividend harvesting strategy. The whole premise is to buy the dividend stock before the ex-dividend date to capture the dividend and then sell the stock either on the ex-dividend date or anytime after. For example, WAM Research ex-dividend date is on the 12th of October 2020, and you need to purchase below $1.44 per share just so that you're not losing money when it comes to selling your shares. The upside to dividend harvesting is that the concept is very simple, but the reality is that you have to time the market, manage your transaction costs, and wait until the share price recovers to a point so that you're not selling at a loss. To be frank, I don't like this strategy at all and I personally avoid it at all costs. Another way to go about dividend investing is either via ETFs or listed investment companies. The upside to this strategy is that it's diversified, it's pre-built, and all you have to do is invest consistently. But the downside is that you don't get to choose what goes into these ETFs or listed investment companies. And besides the standard transaction cost, you do have to pay a management fee every year as well. When I started my investing journey, ETFs and listed investment companies are where I built my foundation. And if you want to learn more about ETFs and LSEs, I've dedicated a full video comparing their returns. So if you're interested in that, I have left a link in the description box below. Now, once you've gotten really comfortable with the stock market, at some point you'll want to pick your own dividend growth stocks. Dividend growth stocks are actually quite different, and because they are still growing considerably, their dividends will grow along with it as well. T. Rowe Price is a really good example, and over the last 5 years they have grown their earnings by 13% every single year. They have grown their dividends by 16% over the last 12 months, and they have also grown their dividends by 12% over the last 10 years. That dividend growth have not stopped for 34 years. With basically no debt and a 39% payout ratio, this is one of the main reasons why I have them in my portfolio. So the upside when it comes to choosing your own stock is that you have an opportunity to outperform the market. The downside to this strategy is that it depends on you to do all of the work and research. And because there is no diversification, you will have to build that yourself with individual stocks. Now, if you're curious on learning how to pick individual dividend growth stocks yourself, I've created a full playlist also in the description box below as well. Thank you so much for watching this video all the way to the end. If you want to be part of my fortnightly Q&A and get access to some additional content pieces, consider supporting this channel via Patreon. And remember to always gently smash that like button right there, subscribe to my channel so that when I release future videos, you'll be the first one to know. If you're keen for more videos, I have put a dedicated dividend investing playlist on the screen for you. Until next time, my name is David. Otto will always do the honors and see you very, very soon.